Every chart has its own heartbeat. Every chart has its own rhythm. So by adjusting the moving average, you match that rhythm. You find that wavelength and amplitude that gives you the signal that you're looking for.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Welcome everybody to Talking Trades. Again, you have Kevin Wadsworth and myself, Patrick Karim. And today, Kevin has a great subject to talk to you guys about. It's about narratives. It's about critical or free mind thinking, you call it, Kevin?
Yeah, free thinking.
Free thinking and how it could help you using charts and to really get some an edge or added value there.
Yeah, sure. So really, the subject of this particular discussion is around effectively having a blank piece of paper. So you're on social media and you're flicking through your feed and you see that people are commenting that stock markets are looking fine and there's no need to worry. Cryptocurrencies are looking fine. There's no advantage in thinking about gold and silver for investing, for example. So you take all that in, and over the weeks and over the months and over the years, that kind of gets ingrained into your mind. And really, I want you to have some critical thinking here. I want you to have the ability to pull up a chart, quickly look at it, and discern from that chart whether what people are saying marries up with the reality or not. Is it true? Is it true that nothing has changed and that stock markets are looking fine and that there's no issue with the markets? So I'm going to share my screen with you. I'm just going to show you a chart. So this is the type of chart that we might look at to make those sort of determinations. This is the 10-year yield minus the 2-year yield chart. And over the last couple of years, in fact, we've been highlighting the fact that something is changing, something big is changing, something big is happening, and it doesn't happen very often. You can see that this chart is usually above the red line. It's usually above zero. The 10-year yield minus the 2-year yield is usually above zero. Okay, so going back to that original point about stock markets and nothing being a problem, this should start to raise some red flags for you. It should start you along the lines of thinking, well, hang on a minute. This yield curve inversion chart has been above the zero line since 2008. That was the last time we had a problem, if you want to call it a problem. We had the GFC subprime crisis, and we had a big recession, of course. Okay, and since then it's been above the zero line. Well, we've gone back down below the zero line, and now we're back up above it again. And it's that process of going down below the zero line and back above it. It's that signature from the chart that tells us that we need to start thinking differently. This one chart isn't going to tell you everything you need to know. It just gives you a general background view that things might not be as they seem. Okay, so if we were to move on to another chart, and this is a chart that shows us something called capital rotation. And we've shown you this chart before. If you've been following these podcasts, you'll be aware of this chart if you follow me and Pat on social media as well. And what this chart shows you is the relationship between stock markets and gold. So those narratives, those stories that you hear on social media, that tech stocks are doing great and Bitcoin's going to be fine and all this kind of background information that's soaking into your brain, test it, pull up a chart and test it. Now, bearing in mind that on these monthly charts, okay, to be in a bear market, for the chart to be in a bear market, you need to be below one of the key moving averages. It could be the 3-year moving average or the 4-year moving average or the 7 or 8 year moving average. Just fine tune the moving average that you wish to use so that it gives you the signals on the chart that you're looking for. That's not manipulating the chart. That's not making the chart fit your narrative. It's setting the chart up so that historically it has given you the signals that you're looking for. Every chart has its own heartbeat. Every chart has its own rhythm. So by adjusting the moving average, you match that rhythm. You find that wavelength and amplitude that gives you the signal that you're looking for. And on this chart, you can see that we're using the 4-year moving average. That's the green line. When the chart is above it and going up, it means that gold is outperforming the S&P. And notably, that happens when the chart has been in a bear market for a long period of time, when it's been going down, and after a period where the stock markets have been in a bull market versus gold. Now, we've had that from 2011, 12, 13 through until around about 2016, 17. And at that point, the chart stopped falling and started going sideways. And that's the first thing that, as a chart technician on these big picture charts, you start to look at. You start to notice that a trend is either developing or stopping, or something on the chart is shifting in terms of the way the chart's behaving. And here we can see very clearly, as we speak at the moment, and if you lock me in a darkened room, Pat, with no news feeds, no social media, I don't need any of that. All I need to do is sit here in a darkened room and look at that chart, and it's telling me everything I need to know. I don't need any narratives. I don't need any stories. I don't need any fairy tales. The chart is telling me that gold is breaking out versus the stock market. The chart is above the 4-year moving average, so it's no longer in a bear market, and it's pushing above the Ichimoku cloud. So from the point of view of the chart, it's telling us that it's in the early stages of getting out of a bull market. And we marked a couple of lines on there as well, a couple of breakout lines, those 2 red lines. Once we get above that secondary red line, it becomes very clear that we are in a bull market for gold versus the S&P. And you can see on the note on the chart there that all 11 S&P sectors are actually technically in a bear market versus gold now. They're below the moving averages and below the Ichimoku cloud, below support. So bringing this evidence together, looking at the charts from a blank piece of paper, allows you to test those narratives. You can test them further by looking at other stock markets versus gold. This is the Dow Jones to gold ratio. So, okay, we've looked at gold to SPX. Now look at the Dow Jones versus gold and see if it's delivering a similar signal that can back up the one that we just talked about. So it gave a signal in 1930. It gave another signal in the period around the late 60s, early 70s. And depending on how you draw the chart, the breakdown occurred around about 71, 72, that kind of time. And then gave another signal in around about 2001 to 2002. And again, differing charts give a slightly different point for the breakdown of the chart, but that's when the signal was delivered. And we're getting another signal now. And okay, so we've only got 3 previous examples, and it's a data set that goes back 100 years, but we don't have a lot of examples to go on. But all 3 examples that we do have to go on give us the evidence that this is another signal, that the Dow is breaking down versus gold. And in fact, we've just broken through a whole range of important support levels. We've broken below the Ichimoku cloud, below one of the key moving averages there. I think actually on this chart, the moving average that I've got shown on here is not the 8-year moving average. It slightly doesn't quite match there. But whether you put the 4-year moving average on, the 7-year, the 8-year, we're below all of those. So we're below the key moving average. And we are now below that red, in fact, 2 red support lines, the steeply angled one and the one that's almost horizontal. So again, the chart is telling us that something is happening here, that if you're free thinking, okay, and you're not paying it, and you don't pay attention to the narratives, then you would have known some time ago, last year in fact, that this was the trend that was developing, that the chart was breaking down versus gold, that the stock market was breaking down versus gold. So from this point onwards, even if gold and silver fall, if the stock market's falling as well, then the ratio is roughly going to stay more or less where it is. It'll sort of go sideways if they both fall together by a similar amount. And in fact, that's quite likely. In fact, it's quite possible that the precious metals fall a little bit more than the stock markets, and we get a little bit of a back test. But it's already given the signal. The signal's been delivered. So it's highly likely, nothing certain, but it's highly likely from this point onwards that any advantage that the stock market has versus gold is what you can think of as a bear market advantage. So any sort of period where stock markets make some gains against gold and silver, the evidence is telling us that that is sort of counter trend, and that the new trend that's developing is precious metals outperforming the stock markets. So that is how to use the charts, Pat, to your advantage and to have that free thinking.
That was awesome, Kevin. It's the charts do not lie. They are there, and use them to your advantage, guys, and you'll be able to be ahead of all the noise we could hear in the media, social media, to get really noisy. Just use the charts like just Kevin showcased. So guys, thanks for watching. Once again, please subscribe, like, follow us to get more content like this. Till next time.